Hi, everyone. Good morning. I'm Michael Wong, and today I really appreciate you taking this Saturday morning to be with us. And I hope you can learn something about life insurance, COVID, and long-term care. So we're just going to get started. And if you have any questions, please type in the chat panel, or you can leave it until the end of the webinar. So I'd like to talk a little bit about what we're going to talk about today. So we're going to discuss COVID-19 and the long-term health effects and life insurance, how to use life insurance for income protection, and some long-term care planning. So a little bit about me. I'm with California Life and Disability, and what we do is we use life insurance for the living to help protect people while they're working, and long-term care to help protect people's income while they're retired. As some of you know, I'm a dentist, and I graduated from UP in 1994. And so I was in private practice in San Francisco, as well as a reservist with the Air Force. So one day I was with the Air Force for about a month, and I was on temporary duty in Alabama, came back, and I got in a car accident. And I didn't realize how bad I was hurt until I tried to go back to work the next day. And so trying to sit and stand and work, I just couldn't make it through a day. So pretty much 3 months after the accident, I was out of practice. And so my income went to zero, but my expenses went up. Acupuncture appointments, chiropractic, co-pays, you name it. I mean, it was a really hard time for me. So I'd like to take what happened to me to be able to share with you how to protect yourself if ever you are in a situation like I am. If you have a long-term illness or short-term illness, be able to use life insurance and be able to pre-plan for those occurrences. So one of the topics, of course, is COVID-19. And in the news, they talk about the deaths, they talk about the infection rate. But I think what they're not bringing up is the long-term effects of people that have had COVID-19. And so in doing a lot of research, I found that there are a significant amount of patients that even after they recovered from COVID-19, they still have complications. So let's talk about the mechanism of how COVID-19 affects people. So it affects people directly. So directly infects the endothelial cells, infiltrates organs and the vessels, which causes inflammation. So, you know, of course, the lungs, the heart, the brain, it does cross, they've done in studies, it does cross the blood-brain barrier. So liver, digestive, kidneys, it affects a lot of the organs. Indirectly, and if you remember from your microbiome classes, it blocks the ACE2 receptor protein that basically this protein is kind of the gatekeeper of your immunologic system. So without this gatekeeper, basically your whole defense mechanism of your body will be released. And that's what happens is basically when it blocks this receptor, you know, your body goes into defense mode. And so all the immunologic response is released. So the immunologic cascade. And what this happens is that it results in the vessel blockage, you know, the fibrinogen that's released, you know, for clotting. What's happening is that it being released is starting to cause blockages in people's vessels. That's why we see younger people with strokes. We see younger people with heart attacks, with kidney problems, with blockages in their blood flow blockages in their intestines. And so let me tell you what's been happening with some of the long-term effects. So The first is the lungs. So this picture is, they call it ground glass. And so with some of the COVID patients, when they take a scan, they see the scarring of the lungs. In some, it's healed. In some, it's 10 weeks out, 12 weeks out, they still see this. And many people, the chief complaint among people in regards to lungs is, I just can't get my breath. I have coughing all the time. I used to be a runner. Now I can barely walk around the block. So we see studies in China and in Europe where people are having issues with this. In terms of the heart, in some people, it's caused arrhythmia, it's caused loss of cardiac output. Again, the fatigue that they have after COVID-19. Third is, we've heard about the strokes, but in some people, it's caused a little bit of almost like dementia, short-term memory loss, long-term memory loss. And one of the predominant issues people have is that they feel they are in the brain fog. After they recover, they are not able to get back to work, get back to their normal lifestyle because they have this fog. Neurologically, we hear about loss of taste, loss of smell. Some of these sensations have not come back. For other people, it is muscle weakness, it is altered sensation. And finally, with the kidneys and digestive systems, because of the vessels being blocked, people are sustaining kidney damage. Some have had to go on dialysis. Some people, they'll have segments of their intestines, the blood flow will be cut off, so that part will have to be excised. So we just see so many complications, and we just don't know what's going to happen in a year, in 2 years. And so today I'd like to just show you a way to protect yourself, because we just don't know, you, me, we just don't know if we get this. Is it going to cause an issue for ourselves? Is it going to cause an issue for our family? And on top of that, is it going to stop us from being able to work, to be able to pay for things for our family? And so that's what I really want to show you today. So how's it affecting life insurance and long-term care insurance? And so it has affected it greatly this past 9 months. So for one thing, if you're exposed to COVID or you have had COVID, they're going to make you wait. So the waiting periods, depending on carrier, is 30 to 90 days. So any exposure or any active, or if you hadn't had COVID, you're going to have to wait now before you even apply. Two, the health criteria are more stringent. So before, at this time last year, if you had asthma and you had hypertension, not too big a deal, you would be able to apply for life insurance. Now, you cannot apply for life insurance. And the reason is they consider it comorbidities, asthma, high cholesterol, diabetes, hypertension. Those are comorbidities. If you have 2 of those, you are unable to be approved for this year. Maybe next year they'll loosen the guidelines, but right now, if you have 2, you need to wait until next year. And the reason they're making people wait is what they found is if you have 2 comorbidities, it makes you more vulnerable to COVID-19. So the insurance companies are making people wait. Third is age restrictions. And this applies mainly to long-term care insurance. Before, with long-term care insurance, you could apply 40s, 50s, 60s, 70s, 80s. Now they have age restrictions. So 65 for some carriers, 70 for other carriers. Beyond that, until they open it up potentially next year, if you're beyond 70, you cannot even apply for long-term care insurance. and premiums, let's talk about premiums. So the long-term care premiums have gone up this year. Life insurance premiums have not gone up yet. But it's not solely based because of the pandemic, it's because of the low interest rate environment as well. Life insurance companies depend on the 10-year treasury, and so that is giving a low percentage. So the insurance companies aren't able to use their money for investments and have a good return because of the low interest rate. So it's kind of a double whammy they have. It's COVID plus it's the low interest rate environment. So next, I'd like to just talk about life insurance. So the traditional life insurance, basically that's for your family. You pass away, it goes to your spouse, it goes to the kids, pay off the house, pay for college, pay for the bills. So the more modern life insurance, what it does is it actually works for you and the family. So let me explain that. So it's life insurance for the living. So they come in different, they have different names for it. Living benefits, life insurance, hybrid life insurance, all the same kind of concept. And the concept is, if you have a life insurance benefit of just say 500,000 and you become sick, you can actually use that money early on. So you don't have to wait until you pass away. It can actually help you pay the bills, pay the mortgage if ever you become sick and can't work. So let's see how that works. So the first part of it is, if you pass away, of course, you get the death benefit. 2, if you ever have a short-term illness, such as you have a heart attack, you have a stroke, renal failure, cancer, you're able to use the money in your life insurance as a lump sum to help you pay for any type of bills you have. 3rd is, if you have a long-term illness, you're in a car accident, you need help at home getting around the house, you can use it for that. Or if you develop Alzheimer's, dementia, you could use it for that as well. And finally, if you are terminally ill, pancreatic cancer, some form of aggressive cancer where your time is limited, you can have your benefits early to be able to pay for maybe in Europe, there's alternative cancer treatments over there. You're able to use your life insurance benefits early to do whatever you want. So let's take an example. So these are clients, and so Sam and Jessica have a bakery in San Francisco. So Sam is 40, Jessica's 30, and they have a son less than a year old. And so this happened in January. So Jessica came to us in 2019, and so after having her son, she said, okay, well, we should probably get some life insurance. So Sam was, I would say, coolish on the idea. But what happened in January of this year, Sam at 40 had a stroke. So that was just a life-changing thing that happened to them. So, but luckily, Jessica convinced Sam to, get a small policy. He wasn't convinced about it, but, she was able to convince him. So he had a $250,000 death benefit. And when they called us, we said, you have the critical illness, which is the short-term illness rider in your policy. So you can actually use your benefits now. So what he was able to get was, within a couple of weeks, he was able to get about 70% of his $250,000, so about $185,000 in benefits early. So that allowed him the freedom to, to take his time to recover. They have some income coming in, just buy him some time until he can get back to work. So a couple of questions that I get from clients, and I'd like to address those, are, so living benefits, remember we talked about, does the living benefits make the insurance policy more expensive? No, in fact, it's about the same price as the regular old traditional, where it's, if you pass away, it just goes to your family. It's about the same price. One note, and I'd like to give you some notes during this presentation. If you look on Policy Genius, when you look at the rates there, they don't offer the same policies, and online they don't offer the same policies as agents. And what makes it different? What makes it different is that the ones online, they are traditionally the old type of policies, death only. So to have the more up-to-date type of policies where you can use the benefits if you ever become sick, those are more from agents. So just to give you a heads up on that. So do you have to pay the advanced benefits back? No, you don't have to pay it back. And finally, one of the other questions is this benefit only in lifetime permanent policies? So it actually is in both term, which is a finite amount of time, or permanent lifetime policies. So this is one of the most confusing parts of my business, is explaining what lifetime life insurance is and term life insurance. And my wife's a real estate agent, so we talk about houses all the time. So I like to use a house as an example to kind of break it down, and I hope it clarifies things for everyone. So term insurance is just like renting a home. You just need the roof over your head. So it's protection only. The other thing is there's low initial cost. And like when you rent, you have your lease for a certain amount of years, 5, 10, 15 years. For term insurance, it's the same thing, 10 years, 20 years, 30 years. So there's a defined amount of period. And you're not really interested in equity. You just want some type of coverage. And just like a rental, you just want a roof over your head. So lifetime insurance is just like owning a house. So you want protection, but you want some type of equity, some type of savings in there. So of course, when you buy a house, there's the higher initial cost. There's lifetime ownership, just like until you sell your home, you own it for a lifetime. And just like a mortgage, there's defined period of payments, 20 years, 30 years. And in home values, we always talk about, how much equity is in a house? If you're going to refinance, how much equity do you have in a house? Well, in life insurance, we call equity cash value. So pretty much the same idea. So let's talk about how a lifetime insurance works. So just say you are paying $300, your premium. And so $100 will go to the life insurance. So you're paying them to be able to give you this leverage. So if you pay $300, you have $200,000 coverage. So you have to pay them to be able to have this leverage. So $200 of that goes into cash value. Remember we talked about equity? So it goes into your cash value, which is basically your money. On top of that, you're able to gain interest on that cash value. So depending on how your plan is, every month, every year, you're getting interest on your cash value. So some common uses of permanent insurance. So there's predictable growth and low volatility. It's with life insurance, with the cash value, it's not going to grow like as if you're buying a stock. It's going to be low growth. It's usually single digit percentage growth, but it's compounded. Some people like to use it for supplemental retirement. You're able to use the cash in your permanent, or the equity in your permanent life insurance to help supplement your income as you retire, when you retire. So tax-free money to the kids or the spouse. So typically, when you have any type of financial vehicle, such as 401k or mutual funds, the growth is always taxed. Okay, with the life insurance, everything passes to the kids tax-free, to the kids or spouse tax-free. So even though the growth generally would be taxed in other vehicles. In life insurance is one of the only vehicles where the growth is not taxed when it's passed on. And estate taxes. So right now, the estate tax exemption is about 11.5 million, so about 23 million tax exemption for estate taxes. But in 2025, that is going to change. I don't know if people remember back in like 2006, 2007, it was about 2 million. So in this area, many people would surpass that. With it being so high, it's hard to surpass that. But in 2025, that exemption is going to go away, and at some point, it'll probably be lowered. And so finally, people like to use permanent life insurance as a nest egg of cash for long-term care. Generally, people don't, they save for the kids, they save for retirement, but they don't necessarily save for long-term care. So it gives them a way to help put money away for long-term care. And if they don't need it for long-term care, then the money will go to their heirs or to the kids. So let's talk about lifetime insurance options. So people in general think of, do I have term insurance and whole life? So whole life gets grouped in as it's one of those things that they see on commercials, the Gerber commercials, but I kind of would like to explain how that works. So whole life is kind of the granddaddy of lifetime insurance options. So how it works is, you're paid dividends. And the difference between what I'm going to show you is basically how you get your interest. And so with whole life, you get interest through dividends. So companies that offer whole life are typically private companies. We call them mutual companies. And what they do is they pay dividends every quarter or every year. So the cash value will gain interest through dividends. And they give you a minimum interest. So no matter how their company performs, you're guaranteed a minimum interest. And on top of that, the premiums are guaranteed. So if your premium is $300 a month, it's always going to be $300. It's not going to go up. It's not going to go down. So that's one of the first options. So 2 is index universal life. So how this works, the interest here is based on a stock index. So typically like the S&P 500, and it's not invested in stocks, but it uses the S&P as a barometer. So just say the S&P goes up 10% for the year. So your cash value, your equity would gain 10%. But what happens if the S&P has a negative year and it goes down 10%? Well, there's what's called a no loss guarantee, which means that you can participate in the gains of the S&P, but if the S&P has losses, you just get 0% for that time period. And with index universal life, the premiums are flexible. So your minimum payment could be $300. Can you pay $200? Sure, you can pay $200 for the next month as long as you have some of the cash value to kind of make up the difference. Or you could pay more, you could pay $500. So the premiums can go, it's more flexible than the whole life. And finally, the third one is variable universal life. And so this is as close to like a mutual fund or stock portfolio as possible. So here is invested in equities. So mutual funds, stocks. And with that, you can have good growth, but you actually have losses. So in this, there is volatility because you don't have a guaranteed minimum interest. There is no 0% loss guarantee. So you participate in the gains, but you participate in the losses. And just like the index universal life, there's flexible premiums. So some of the questions I get is, well, how much life insurance do I need? And this is just kind of a ballpark figure. But basically 10 times your annual income as life insurance. That's about what you should aim for. And then 5 times annual income for a short-term illness, long-term illness. So 5 times, to fend off long-term, to pay for long-term care expenses. So when I go on webinars, and maybe this is me, but I kind of like to know how things cost, because sometimes I go in there and I see, oh, I really like this, but how much does it cost? So I like to just show you about how much it would cost for a term policy. So in these term policies, this is like the best rating, which means that you have no medications, you have no outstanding, health issues. So when you see that it's a million, you could see it's $1 million benefit, and these are the years. So, you know, obviously if you're 30 years old, you're healthy, and excuse me, the pink is the female and the blue are the males. But you can see here, the younger you are, the earlier you plan, the cheaper it is. When you reach 50, then they're cutting down the years. So before you're able to get a policy for 35 years, then it goes to 30 years, then 27, and then 23. And you can see the prices escalate. But I just kind of want to be transparent, because I know when I go to the webinars, I just want to know the price sometimes. So I just wanted to throw it out there and, you know, kind of give you an idea, a ballpark idea of how much things would cost. So let me give you an example. So this is kind of like a typical plan that we planned for clients. So Heather is a physician. She has 2 kids, and she has some dementia in her family with her parents, and she has cancer. So, you know, she just wants some complete coverage. She wants good value, and if possible, she would like her money back. I mean, who would want their money back? So with her, she decides she is going to get $2 million in total coverage. And she is going to have $500,000 lifetime policy, and she will fill that out with a $1.5 million term policy. Okay. So the premiums for the month are, she pays $1,000 a month for the lifetime policy and $140 a month for the term policy. For the lifetime policy, she pays the life in 20 years. So so this is here. And for the term policies are just pay as you go, just like your home insurance, just like your car insurance, you pay as you go. So same thing with the term. So she pays it for 35 years. And the total premiums that she's paid out after 20 years is $240,000. And the term policy, she's paid $59,000. So let's fast forward to when Heather is age 76. So the kids are out of the house. Hopefully she's retired by then. So here she still has the lifetime insurance of $500,000, but the term has done its job. It's protected her while the kids were at home. Hopefully they're still not at home, but they've they've gone off on their own, and that is expired. She doesn't need that anymore. So her cash value, remember we talked about equity, her cash value is now $760,000. So this is what she put in, $240,000. It's grown to $760,000. So if she were to pass away at 76, her total life insurance to the kids would be $1.26 million. And so how that works, it's the cash value added, or excuse me, the life insurance added to the cash value equals this. And if she needed long-term care, then this would be available for long-term care as well. So next, I'd like to talk about long-term care. And with my family, I've seen it on both sides. I've seen long-term care planning where I've seen long-term care where we didn't plan, and I've seen long-term care where we did plan. And so with my mom had lung cancer. And so toward the end of her life, after 13 months of chemo, she was deemed terminal. So my wife and I were doing everything, the cooking, cleaning, personal hygiene for her. But when she was terminal, her condition worsened more. And at that time, I was still having a lot of back problems. So we just couldn't handle it anymore. So we need to hire help. And when we hired help, my mom needed 24-hour-a-day care. So 24-hour-a-day care cost us about $17,000 a month. But it was a godsend because it really allowed me to kind of wrap things up with my mom, talk about our lives together. And instead of being a caregiver, I was just going, I was able to just be a son again and to spend time with her. So all in all, after 3 months, we spent about $50,000 with my dad. And luckily, after going through that with my mom, we said, okay, we cannot go through the same thing with my dad. So for my dad, we pre-planned, and luckily we did because my dad developed dementia and we put him in a senior care facility. And, that really helped because, we didn't have to do the cooking, the cleaning, the multiple doctor's appointments because he had multiple medical ailments, and the 3 a.m. calls because his behavior was just getting erratic. So we put him in the senior care facility. And over time, he initially started out in the general population of the senior care facility. So he's about $4,000 a month. But as his condition worsened, especially with the Parkinson's, his dementia just skyrocketed. So his care was at $8,000 and it peaked at $11,000 a month. And in looking back, my dad was in the care facility for about 6 years. So overall, we spent about $750,000. But we were fortunate in that after my mom passed away, we bought him a long-term care policy, and that helped offset a lot of the costs. So this quote really rings true, is that pre-planning is not necessarily for yourself, but it's really for your family. So I truly believe that. So what is long-term care? I mean, we hear about it, but really what is it? So it's just assistance with everyday activities. So everything you do on your own, taking a shower in the morning, eating breakfast, getting dressed, getting out of a chair, bed, help in the restroom, and being able to control your bowel and bladder. So how it works is that with long-term care, basically there are 2 triggers that would say, oh, you need long-term care. And the first could be a physical disability. So if you have a stroke, you're just older, or you have Parkinson's disease. So the second trigger is cognitive impairment, like my dad, he had dementia, or if he had Alzheimer's. So there are 3 levels of long-term care. So the first is home care. Basically, someone comes in, they help you around the house, navigate around the house. They might do some light housekeeping. They might cook a meal for you, but basically it takes the stress off of your spouse or your kids. Some of those can do it. 2 is assisted living, which is where my dad was. There's Sunrise in Belmont, there's Atria, Foster City. So those places are assisted living facilities. And they always have aides 24 hours a day. There's always someone around to help assist you. And it's all inclusive. So it includes accommodations, meals. They will actually take you to doctor's appointments. You can hire someone to go with your loved one to the appointment, so you don't have to take off of work to go with them, and they'll report back. And they have social functions. So with my dad, he really liked the social functions where they would go to different restaurants, they would drive to San Francisco. So, in terms of assisted living, I would say my dad actually had a much better time there than being home alone. And so with the next category, so the 3rd level of care is the highest level of care. And so this is what we always think about with long-term care. Oh, it's a nursing home. Well, with the nursing home, it's basically the same as assisted living, where there's aides and there's accommodations. But the main difference is that there's a 24-hour medical staff. So there's always a nurse or a physician on staff 24 hours a day. And they can actually do some medical treatments such as dialysis there. So I'd like to just talk to you briefly about how much this costs in the Bay Area. So these are today's prices. So home health aid is about $78,000 for a year. Assisted living is about $59,000, and nursing home is about $160,000. So in regards to inflation, so inflation is about 3 to 5% a year. So in 10 years, you see that the prices increase 50%. In 20 years, the prices will double. So that's typically how it goes. So in 20 years from now, we're looking at 144 home care, 106 for assisted living, and the nursing home would be, almost 290,000. So how long do people need care for? So this quote here is basically what the American Long-Term Care Society states, and it's pretty common. So 70% of Americans will need some form of long-term care after 65, and whether that's informal care is your spouse or your children helps you. So it's inclusive of the informal care and the formal care, which is you're hiring someone. But in general, this is pretty accurate. So how many years of long-term care do people need? So for men, it's about 4 years. For women, it's about 5. And if you have Alzheimer's disease, it's more on the lines of 8. And Parkinson's disease, which is what my dad had, it's 11 years. So, okay, so things are expensive. So how are we going to pay for it? And so that's what I want to talk to you about here. So there are 4 options that I'd like to talk about. So first is Medi-Cal, Medicaid. Then there's traditional long-term care insurance. There's living benefits life insurance. And there's asset-based life insurance for long-term care. So let's talk about Medi-Cal, which is basically Medicaid just for California. And so that is income-based, meaning that your income per month has to be under $2,000 per month. And they base it also on countable assets. So, they'll look at your retirement, they'll look at your 401k. So you have to qualify to be able to be eligible for Medi-Cal. And with Medi-Cal, they provide nursing home coverage on space availability. So if you live on the peninsula, there potentially could be no beds on the peninsula. So you might have to be in Oakland, or you could be, further east or south, maybe in the Central Valley. They provide limited at-home care, but they provide it at a reduced rate. So typically they'll pay maybe $16 to $20 an hour, when a home health aide is actually more along the lines of $38 an hour. So let's talk about traditional long-term care. So with traditional long-term care, basically it's insurance to help pay for someone to come to your home, or if you need to go to the facility, let's just say it's a senior care facility or the nursing home. So that will help pay for the cost. So how it works is it's a reimbursement policy, which means you pay first, you submit the receipts, then they will issue you a check the next month. So basically you're paying almost like a month ahead, and they'll reimburse you the following month. So one of the other things, it has finite benefits. So it's either like 2-year, 3-year, 5, some have 6, not too many have 6 years of benefits. And some of the typical common complaints about traditional long-term care is the premiums are not fixed. There have been many premium increases in some of the long-term care carriers. Mutual Omaha, Genworth is the biggest long-term care. They've had 40% increase in premiums. and CalPERS, if everyone has heard of CalPERS. It's for people that work with the state that are retired, which my dad did. So they've had significant increase in premiums. But I would say that the biggest complaint is the use it or lose it, meaning it's just like health insurance, car insurance. If you need it, it's there. If you don't need it, you're not going to get your money back. So the third option is kind of what we went over. It's the living benefits life insurance. So it pays for the same things as traditional long-term care. But one of the main things is you can receive the benefits as monthly or a lump sum, and there are no receipts. So you can get a check and you could do whatever you want with it, whether it's pay someone or you need it just to take care of your bills. You could do whatever you want with it. It has finite benefits. So based on how much you purchase initially, that's your benefit. The other thing is the premiums are fixed. So they're never going to go up. They basically are going to stay flat. And one thing is use it or pass it on. So if you don't ever use it for long-term care, and you remember it's life insurance. So when you pass away, it's going to go to your spouse or it's going to go to the kids. And finally, the last one is kind of a unique way of helping to take care of long-term care expenses. It's called asset-based life insurance. And so it takes care of the same things, home or facility. It's a reimbursement, which is just more like the traditional long-term care, but it has an unlimited option, which means that unlimited lifetime. So the other ones do not have unlimited lifetime. But this is the only one that if it costs 1 million, 2 million, 3 million, it would cover it. The premiums are fixed, so which is great. You know what you're going to be paying for how long. And this is one thing that's unique about it is you can use it for long-term care. If you decide you just don't want it anymore, you can return it, which means you can get your money back, 70–80% of your money back. Or if you don't use long-term care, you can pass it on. So which means that it becomes life insurance. And when you pass on, then the money would go to your kids. So and the last two is 2 people on 1 policy. So when you apply, it's two people. So husband and wife will be on 1 policy. So you qualify together, health-wise, age-wise. And this is another unique feature is that you can use a taxable account such as your 401k, IRA, SEP IRA to fund your long-term care. And so basically 401ks, IRAs, and SEP IRAs, they're taxable. And when you use that to fund your long-term care, when you receive the benefits, it becomes non-taxable because of the Payroll Protection Act. Anything that comes out of from long-term care will be non-taxable. So let's look at a couple examples to kind of illustrate this. And so this is kind of the typical traditional long-term care. And some of the aspects of this is in any type of thing that is related to long-term care. So it kind of gives you a baseline. So if you look at your own policy or you're just looking around and talking to agents or looking on the internet, it kind of give you an idea of what to look for. So right here, so Margaret is getting a traditional long-term care policy. So there's a 90-day elimination. So basically that's her deductible. She has to pay out of pocket for the first 90 days. So the day limit is $200 a day, which means that the max the insurance company will pay is $200 a day, or times 30, $6,000 a month. So years of coverage, 3 years. So when you look at policies, it's going to say years of coverage. It doesn't mean that after year 3, she's not covered. Basically, the years of coverage are really a multiplier. Okay, and you'll see that next. So for Margaret, so she has 36 months of coverage, which was here, and she had $6,000 per month. So her total lifetime coverage is $260,000. But Mike, you told me about that, the inflation, it increases, expenses. So what she does is she adds inflation protection. So in long-term care policies, they have long-term care inflation. And that's one of the things you can choose. You can choose 2 years, 3 years, 5 years. So that's a breakdown of how a long-term care works. So let's look at one of the last category, the asset-based care. So that works a little bit differently. So Jake and Ellen, so they're going to purchase a joint long-term care policy. Remember, 2 people, 1 policy. And what they're going to do is they're going to, instead of using their monthly income, they're going to use money from their 401k. So they reallocate $160,000. And so what that gives them, it gives them $72,000 per year of long-term care. And with that amount increases 3% a year. So remember we talked about inflation, it's going to increase every year. And what they have is unlimited lifetime benefits. Remember, it's 1 million, 2 million, 3 million. They both have unlimited lifetime benefits. 2 is, okay, well, just say 10 years from now, 15 years from now, they decide they just don't need it anymore. So if they decide to quit, they get approximately 70–80% of their premiums back. 3rd, if they pass away, they don't use the long-term care, their children will receive $200,000 in death benefits. So, with asset-based care, it's, you can live, quit, or pass away. So some final thoughts. So these are some tidbits I'd like to give you. If you're ever considering life insurance or long-term care, especially in this environment, there is a 30-day free look period. So with life insurance and long-term care, it is taking longer to underwrite people, which means that when you apply, it will take about 60 or 30 to 60 days before the company will make a decision. So really, after they make a decision, you still have an extra 30 days. So it's almost like a 90-day free look period. So if you're undecided, but I would advise apply anyway, and then you can think about it. And you don't necessarily have to put money into it. And I'll talk about it next point, but you can always get your money back. It's almost like that there is no obligation, there's no risk. So temporary insurance. Temporary insurance is something I think that people don't know about. When you apply, especially for life insurance, the minute you put in your application, you're eligible for insurance. Whether you are accepted or not, you can have insurance right when your application goes in. And how to get this is you just put a good faith 1 month premium along with your application. Once you do this, you have temporary insurance. So while you're waiting for a final decision, you actually have coverage. And so that's something that when you're looking, I feel it's very valuable, because you just never know what can happen in those 30 days, 60 days, 90 days between when you applied and when there's a final decision. And another thing I like to tell clients is, if you're undecided on how much coverage you want, I would aim higher. And the reason is, just say you're looking at 1.5 million. But the cost might be higher than what you thought. So maybe you're thinking, oh, should I do 1 million? So I would say aim higher, apply for the 1.5 million, because you have time to drop it back to $1 million if it doesn't fit within your budget. It's always easier to aim higher and then back down. If you were to apply for $1 million and try to go to 1.5, then you might have to go through underwriting again. It'll just be a lot more paperwork. The rates may have changed, so it's easier to go from a higher amount to a lower amount. And this is really important. So disclose all relevant medical conditions. You know, when you talk to your agent or whoever is helping you, make sure you're disclose everything. Whether you think it's important or not, it's good to disclose it. And the reason is you don't want to have something missing from your application that the company will find on your medical records later. And when this happens, they will deny you, or they will increase your premiums because they feel that they can't necessarily trust you. The other thing is, if you ever have a medical condition that needs explaining, have your agent write a letter to the insurance company and submit it with your application. Because when the companies look at your application, they're looking at objective things. They're looking at lab values, excuse me. They're looking at your doctor's records, but a letter coming from your agent explaining the situation, just say you had some condition and that was 2 years ago, you have had no complications. So if this is explained, then it really makes the application process go through smoother. You can have a better rate for your premiums. So this is really important. And finally, with medical exams. So most life insurance over $250,000 are going to require a medical exam. Anything under $250,000, typically sometimes, depending on the company, they will just do it. They would issue a policy for you without a medical exam. But there's a way to prep for a medical exam. So when you do this, talk to your agent. There's different things you need to do, what you should eat a week before, how you should, what you should say to the person that is coming to your home, what exercises should you exercise that day. But there are certain hints that your agent, or if you can always ask me to give before the medical exam. And finally, if you ever have any questions, I can give you a 30-minute consultation. And, we're kind of all in this together. I'm just, I really am passionate about just trying to help people and to protect their income, because I lived through it. My parents lived through it, and, it's a tough time. And, I would just like to, help. And if you have any questions, you can always email me or text me any questions, whether you're looking at something or, considering, looking at what you had before. So this is my website. So Cal Life Long-Term Care, and this is my contact information. So I really appreciate you spending the time with me today, on a nice Saturday, my son's birthday, but I really thank everyone for coming. And if you have any questions, let me know. Thank you.